about his observations. Obviously, Karl tracks the currency story as well, so there's a lot to digest. Would you say that the mood of the markets has been changing with more negative leaning headlines than positive of late?
Oh, no question. Of course, the tariff threat on Friday and Saturday there, that clearly, sort of hammered sentiment in Canadian markets and turned, I think, investors globally more skeptical on Canada's growth prospects, right? It wasn't a pretty picture going in, but the reality is that the sort of Damocles sword that is hanging over the Canadian economy right now, this 30-day deadline, that is hampering, that investor sentiment. It is hampering business sentiment and very likely affecting how consumers think about the economy and about the future.
I think we just have to think about how we live a healthy life in this new era in Washington,
right?
Because it seems like every day there's going to be something that might seem troubling to some.
Yes.
But the market's going to have to find its groove on this. Now, I guess on the tariff front, for the markets, have they gone back to, okay, we're now pricing in less of that threat, or are they getting to the point where they're going to kind of, it's like this tax that they have to just sort of put on the trade
right.
and keep on there for the foreseeable future until something changes?
That's really well put. So the way we're thinking about it in foreign exchange is that it's just essentially a risk discount that's applied to any trade-sensitive currency, any currency that is exposed to potential tariff risks in the future. It is not equivalent to what would happen if tariffs were actually implemented, but it does represent essentially that market participants are looking for insurance at any given time against something that might hit in the future. And then on top of that, all of these currencies are underperforming because this is expected to scar the underlying economy, right? Even if the tariff threat does not come through in the next 30 days, 60 days, 90 days, the reality is that shift in sentiment among businesses and among consumers is going to slow growth. And so, that widens rate differentials against the US and sets the stage for further underperformance, or at least not outperformance against the dollar to the degree that you might expect.
I have to say, unfortunately, I had a rather sobering conversation with the former Bank of Canada Governor Stephen Poloz this morning, who put it in pretty simple terms: when companies that are based in Canada but have been building cross-border businesses have to make decisions on where their next dollar goes, that it is increasingly getting easier for them to look south of the border than here at home.
No question.
And so I guess that raises further questions about economic performance regardless of tariffs, even if the tariff threat is a further catalyst.
Yes.
I mean, he already thinks that technically we've been in a recession. So first off, on interest rates, which is a blunt tool, but likely one that the Bank of Canada will continue leaning on. Yes. Are you anticipating more rate cuts through 2025?
I am. I think that we're going to see that rolling sort of recession, as you might call it, hitting various sectors in the Canadian economy. Canadian consumer consumption is not going to recover, to any big degree as long as this threat is hanging over our heads. That means the bank needs to continue moving rates toward neutral. Now, I would say as well, though, that at some point they are going to worry a little bit about imported inflation risk. So that is going to put a floor under interest rates. I don't think it's a major threat to the Canadian economy at this point, but the currency depreciation that we've seen thus far, in addition to potential bilateral tariffs, that could mean that the inflation outlook does get exposed to a little bit of upside, and that means that the bank can't go as aggressively toward neutral as they might have anticipated otherwise. So couple more rate cuts this year, but not 3 or 4 that you might see in sort of an emergency scenario otherwise.
Okay, let's put all of that really helpful context into market terms. We're looking at the Canadian dollar. I'm actually taking a trip south of the border, and it's going to be more costly. But
yes.
It's not about me. But we're sort of like on the doorstep, I suppose, of 70 cents here. But I have to say, like a lot of people have been predicting, you should not be surprised if we can make more of a move towards 65 cents. You're the guy who does this. What do you think?
Well, frankly, if anyone gives you a point forecast at this point, you need to open the trap door on the other side of this desk and just drop us down to purgatory. Okay?
Oh, okay.
Yeah. The reality here is that we do have a setup in the Canadian dollar, which is asymmetric. In other words, there's some limited potential for upside. There's a lot of potential for downside in the event that tariffs are passed. But anyone who can make a forecast right now about where the currency is headed is delusional. Right. At the end of the day, we have a really unpredictable situation in the White House. We don't know what they're going to do next. We don't know what the Trump administration might do in terms of trade policy, in terms of economic policy. That's going to have spillovers for Canada, and the intersection of all the factors that that are currently in turmoil mean that we don't have a predictable path that we're going to follow. So one thing that is interesting is that going into Friday, right, the Bank of Canada's model had suggested that a lot of trade war risk was priced into the Canadian dollar. Private sector models were showing big potential swings on the possibility of implementation. Ultimately, the Canadian dollar only moved about 1.5%, right? And so what's interesting here is that, and this was while we thought that tariffs really might be implemented.
Yeah.
So what's interesting here is maybe the Canadian dollar has largely priced in this possibility, right? And if that's the case, then maybe those forecasts for a sort of semi-apocalyptic drop in the Canadian dollar are not going to hold up in the event that we actually do see the shock come to fruition.
Not to get too wonky, but is it correct to say that there were some traders making bearish bets against the currency, and
of course.
And if you weren't seeing as dramatic a possible weakening against the greenback as might have been thought, does that mean maybe people closing out some of those positions or something like that?
I don't think profit taking would have necessarily driven it, but the fun part is very, very simple dynamic, actually. It is, if you were to take a big short position on the Canadian dollar, right, something that lasts more than a couple of weeks that you expect to pay off over a couple of weeks, right, you would be crazy to do that on Monday, because there was the possibility that Trump comes back and announces something completely different, and prior history suggests that you should not be taking that kind of bet, and so to some extent I think the currency did not react as dramatically simply because the speculators didn't jump on board. And I was watching very closely, by the way, at 8:30 on Monday morning, waiting for retail money to jump on the trend, and they did not. So this does tell me that to some extent it's capped, except for in the case where we do see the tariffs implemented and we have longer-term drag on the Canadian economy.
Just want to squeeze one final one in. It's not an easy one, but all the common commentaries that the U.S. economy is actually in great shape, that the central bank there can take its time when it comes to thinking about interest rates, and that tariffs represents an inflation risk there and a growth risk for Canada. Is there any possibility that the math is wrong?
Yes.
Like if all this stuff goes haywire, that the U.S. economy could stumble as well?
Oh, absolutely. And I'm betting that it will. I think that the U.S. economy absolutely is going to stumble here. Firstly, we had slowing momentum going into the latter quarter of last year. If we look at employment conditions, retail spending, all of these things, the momentum in the economy was beginning to slow. But the turmoil that's being caused right now, particularly within the U.S. government, that's not likely to have a positive effect on growth, right? A lot of the assumptions that went into the Trump trade are not necessarily going to play out in reality. And so I would expect that turmoil to eventually weigh on business confidence. I think you are seeing a bit of that in the corporate earnings that are coming out and in the earnings forecasts that are being provided. And that should eventually mean that that rate differential, the expected growth differential between the U.S. economy and its global counterparts begins to narrow. So my bet is that by the end of this year, we start to see the U.S. dollar declining or retreating against currencies like the Canadian dollar.
Okay, so that's an interesting Canadian dollar support to be watched. We don't have a trap door. You seem to be making a prediction there, but
I sure am.
Great to see you. Thank you very much,
You
Karl.
as well.
Karl Schamotta joining us from Corpay.